In this recording, we're going to look at an IAS 1 question from the question pack 3 focused on key to limited. So this is a basic trial balance that you're given at the 30th of June 2016, which balances, and you're also given a number of bits of additional information that you're going to have to make adjustments for. And what's required then is a statement of profit or loss for the year ended 30th of June and a statement of financial position at that date as well. So a fairly standard IAS 1 type question. We're given a trial balance with debits and credits. And again, we have to be able to distinguish then, well, if the debit, is it an asset or an expense? If it's a credit, is it a liability, income, or is it a capital or equity amount? And we'll go through each of them as we're preparing the set of financial statements. My advice would be for you to go down through each of them now yourself initially and see can you make an attempt at the question. And then you get to follow through and identify where the problems are and figure out where you may have went wrong. So what we're going to start with, we're going to start with the additional information, and we're going to take a note of each one and do an adjustment as required to bring that item into the trial balance. So you've looked through the trial balance yourself, hopefully. You've identified the key items, anything that might stand out as unusual, and we're going to do the notes, the accounts now, and make those debits and credits. So we're going to do working one, closing inventory. So remember, bringing in closing inventory is going to be debit inventory as a current asset and credit cost of sales. So nothing more complicated than that, and that is going to be 155,000. So we're just showing, sometimes you can be asked for journal entries, so it's no harm being able to complete those as well. That's inventory at the end of the year. Inventory at the start of the year, 2015, is already in as an asset, and that's going to go towards cost of sales, because it's going to be opening stock plus purchases. Depreciation then, working two, is going to be provided on machinery at 20% cost and vehicles 25%. So we go do here working two. Machinery depreciation. So machinery depreciation in this case, it's 20% on cost. The cost of machinery is 420. So 420 times 20%, which is 84,000. So 884,000, and what you're going to do there is debit depreciation expense in the SOPL, credit accumulated depreciation in the statement of financial position. So nice and straightforward, but just make sure you're happy enough with the journal entries and particularly where the calculations come from. For vehicles, your depreciation here is going to be 25% of cost. Your motor vehicle, we have down here, 80. So it's going to be 80,000 times 0.25, which is 20,000. And again, the entries are going to be the exact same. It's going to be debit depreciation expense, 20, credit accumulated depreciation, 20. Now, what I would advise students, sometimes they can make mistakes and forget that accumulated depreciation is an addition to the opening balance. So the opening balance here is 152. So accumulated depreciation is now 152 plus 84, which is 236. And that 236 is what's going to go into the statement of financial position. So I'm just highlighting to make sure you don't just put in the 84. Don't forget the opening balance of accumulated depreciation, which is in the trial balance. Same here. The opening balance of accumulated depreciation is 40,000, and you're adding on another 20. So that means the closing balance in the statement of financial position will be 60,000. And again, we'll slot that in. So this is the two things that we're going to have going to our statement of financial position. So just trying to prepare things as we go along. So that's our first two adjustments complete. We then look and we're told provision should be made for auditor remuneration. What that means is the auditor has done their job, but we haven't got an invoice yet. So that's going to be working three, debit audit expense, credit accrual. So you have an accrual there, which is in current liabilities of 12,000. So 12,000 in both. That's fairly okay, just like an accrual. You also then you're told you have a prepayment of 3,000 for insurance. So your insurance bill up here of 17, actually 3 of that is for next year's accounts. So what we do with a prepayment, hopefully you've covered your online quizzes, is debit prepayments, which is a current asset, and credit insurance expense. and that is going to be 3 and 3. So your correct insurance expense now is 17,000 minus 3. So it's actually going to be 14,000. So that's something to watch for, that you make sure you remember that adjustment as going in. And we'll slot that in. 17 minus 3. So that should be, 3,000. So your next note then, note 5, is the provision for bad and doubtful debts should be made equal to 5% of outstanding receivables. So we're no mention of bad debts here. So what we're told here, the provision for bad debts is 8. Current trade receivables are 300. And we're to make 5%. Working 5. Old provision. So the opening provision was 8,000. The new provision is 300,000 times you're told 5%. So 5% of 300 is 15,000. So that is an increase in the provision. This is important that you understand how to deal with a provision. Where there's an opening balance, you're only looking at the movement. An increase means debit bad debt expense in the SOPL and credit the bad debt provision. So you're increasing the provision by 7 up to 15,000. So remember, the provision is now sitting at 15. You had an opening balance of 8 on the credit, and you're bringing it up another 7. So make sure you're happy with how the bad debt provision works. The new provision now will be 15. Note 6 tells you corporation tax is to be provided for 60,000. That's an expense. So you're going to debit tax in the SOPL, and you're going to credit tax in current liabilities. This is something you owe and you haven't paid yet. 60,000. So again, there can be some basic ones, but this is just hopefully a refresher of what you'll have done in AF1 and getting you back up to speed before we bring on more additional topics in AF2. The next one you're told is investments had a fair value of 30,000 at the end of June. Well, we need to go back and check, well, what were they in there already at? They were in at 28. So we need to increase their value by 2,000. So working 7, debit investments, because you're increasing the value of an asset, 2,000. That is the 30 compared to the 28 it was in the statement of financial position at, or the trial balance, and then credit the SOPL, and that will be other income. Because the value of the asset has gone up, that is good. That is good for performance. So that's your keynotes, and then you're just told about the authorized share capital. That has no impact, because what we're interested in is the issued share capital, which is the 250,000. You never put in authorized, it's only ever the amount that's actually issued to shareholders. There is one other adjustment that a lot of students might have missed out on. They tell us debentures here are 10% and the loan is 70,000. So that means we should have been paying 10% at 70 is 7,000 per annum in interest. We have no interest expense here. So that was a tricky one to see where you're paying attention. Why were we given the 10%? So working 8 should have been there. Debit interest expense, or you could call that finance cost. Either one is fine. Credit accruals in current liabilities. And that's going to be 7,000. 7,000 because you have a debenture of 70,000 and the debenture is charging 10%. Right, so that's something you need to watch out for when you're going through. 70,000, 7,000 debit expense, increase your accruals. That was a tricky one. That was kind of a bit hidden in the question that you really have to have your wits about you. So that's your first key thing that you need to practice on. And that's why we gave you the revision quizzes online, practicing your calculations and practicing your debits and credits, because they form part of any IAS 1 question, is setting it up. The next thing now we're going to do is set up a statement of financial position, or statement of profit or loss for year ended 30th of June 2016. And what you're going to do is you're going to take each item. Now be careful here, this is where students fall down in terms of their technique. You need to look at each item on the trial balance and tick it off as you put it in, and check each adjustment you've made here, and any of those that impact the P&L should be ticked off and put in as well. So ideally you will have everything ticked off once you finish the question, and you won't have any obvious omissions. Because if you leave one thing out, the whole financial statements are not going to balance. So what we're looking at here is we're going to start off with how we know we start off a statement of profit and loss. We're going to look at revenue, opening stock, plus purchases, less closing stock gets me cost of sales, which gets me to gross profit. Right, that's always going to be the layout of a initial start of a statement of profit or loss. The revenue, we made no adjustments. We're taking that directly from the question, 2.1 million, 2,100. So again, what I'm doing here is I'm leaving it in full figures. I am not rounding to 3 zeros. If you wanted to round to 3 zeros, that's fine as well. Either one is fine, as long as the examiner can clearly see what you're doing. You can knock off the last 3 zeros if you wanted as well. Opening stock, so the revenue, we will just highlight. I'm going to put in yellow to say that's done. Opening inventory 134, we slot that in. Purchases, we're given here 1240. So that's 134,000. 1.24 million. That's also in. And be careful now, closing stock is coming from working one, which we had already, minus 155,000. So my cost of sales, which will be a negative figure, is going to be 1219. So I've taken the three items in the trial balance, and I've come to here and I've highlighted to say credit cost of sales means reduce cost of sales because you're crediting an expense. So I'm just ticking them off as I go. You might just do a little red tick, but again, it's just about practice, so you're not missing out on anything obvious. So that's your first key element. And that will get me gross profit is revenue minus cost of sales, which is 881,000. You have two things that go in then. You have other income, and then you have expenses. You add on other income, you take off your expenses. So let's go and have a look at the trial balance. Is there anything on the credit side, because that's where income would be, that should go into the P&L? Well, payables and debentures, they're liabilities. This one, investment income, that is 4. Tidy that up. Investment income of 4, and there's no other here. I'll just highlight that to say it's done. No other credit there that is an income because they're all liabilities or they're accumulated depreciation. So it's useful to sense check it here. And we then sense check, is there any credits here? There will be other income. There is from working 7, 2,000 for change in fair value. So we do fair value movement, working 7, and that will be 2. All right, so you can put the other income in this column if you wanted to. So you can just thought that the 6 then goes here. Now that should of course be 4,000 and 2,000. Just so we're consistent, be careful there with the zeros. We're doing full numbers here. So it's a bit monotonous, but it's repetitive. And a good student will have a good technique honed. You then go to your expenses, which should be on the debit. Advertising we know is an expense, which is 30,000. We go down long, bank is an asset, receivables are assets, director remuneration and electricity. Director remuneration, electricity. So we'll slot in those. Director remuneration, 55. Electricity, 32. So all coming straight from the trial balance. A debit is an expense or it's an asset. And it's for you to understand that. The insurance, be careful. Insurance is 17 minus 3. So that is going to be 14,000. And remember, that's coming from here. We have insurance now gone in. But we also remember that actually those 3,000 of that was prepaid. So we credited the insurance expense 3,000 from working 4. So don't forget to put both of those in. And I'll put even here as kind of the end to reference working 4. Just so they know where the adjustment is coming from. So then working down along, investments are an asset. Machinery is an asset. Office expenses, which is 49,000. No adjustment. And we can highlight that. No other expense there. Rent and rates, R&R. That is 75,000. Again, no adjustment there. So we just highlight the rent and rates. And wages and salaries, then the last one, 358. So that's the last one in the trial balance. Wages and salaries, 358. But again, what a lot of students forget, don't forget you have to go back and look at your adjustments in case you had any other expenses that need to go in. So for example here, we've depreciation 84 for machinery, depreciation 20 for motor vehicles. So slot those in. Machinery depreciation, 84. Motor vehicle depreciation, 20. Another 2 slotted in. And remember, these questions, the more you slot in, the more marks that you're getting. So it's about ticking them off and double checking every time. Audit expenses, 12 has to go in. We've dealt with insurance, and bad debt expenses, 7 has to go in. So we're going to do those both as well. Just slot them in. Audit expense, that is what working we're looking at there. Working 3. And of course, I can reference those working 2. Just get that discipline to show the examiner what working they're coming from. That's 12,000. And then bad debt expense. And that's coming from working 5. That will be 7,000. Because you're debiting expense, which means you're increasing the expense. All right, so if we go back there, we've looked at each of them then, we've highlighted, yeah, all those income statement items are taken care of. Tax will be dealt with in a second, as will interest expense, because they go after operating profit. So it looks like we have all the items there. So we tot those up, and we get total expenses of, that's wrong there, 5, and then we times that by -1, is 736. So that gets us to what we call operating profit, or otherwise known as profit before interest and tax. You then take off your interest, otherwise known as finance costs, which is our working 8, and then you will get profit before tax, and you take off your tax, which we have as working 6, and that gets you profit for the year, otherwise known as profit after tax. So there is a nice structure to it, and that's all mandated by IAS 1. So your operating profit then is your gross profit, 881, plus your other income, don't forget that, of 6, unless you're 736. So you should get operating profit of 151,000. Your interest expense is 7,000, which will reduce that to 144. And your tax is 60,000 from working 6, which will reduce your profit for the year to 84. So don't forget to slot those in, and we tick off each of those. The interest expense is now in, and the tax expenses in. They should not be in with the rest of them. So they should not be up here because they have their own place in the statement of profit and loss. And that is important in terms of getting your presentation right under International Accounting Standard 1. So that was important that you looked through that. You did your adjustments. You went through all the trial balance to figure out the key items, and then you ticked them off and slotted them in as you go along. And hopefully you got somewhere close to, if not exactly, 84,000. The other aspect that we are asked for here, which I'll do this side, is a statement of financial position as at 30th of June 2016. So notice here, this is for the period, this is at a particular date. You then firstly go assets, and we look at non-current assets first. So we have 2 non-current assets in the question. We have, in this case, vehicles and machinery. Machinery and motor vehicles. Now just be careful with the figures you're getting here. The machinery, its cost was 420, and we said accumulated depreciation now, the correct one is 236. Don't just use the 84 or don't just use the 152, add them together. So that is 420 minus 236. 420 minus 236, which is 184,000. Your vehicles, be careful, the cost was 80. You had opening accumulated depreciation of 40, and we had extra accumulated depreciation of another 20. So that means accumulated depreciation is now 60. So it's 80,000 minus 60. So it leaves you with 20,000 net book value, or what's known as a carrying value for non-current assets. And we'll tidy that up. So that's motor vehicles. We just go down and since checked in, do we have any other non-current assets? None of those. That's a current asset. They're liabilities. Investments, they would be, now there's subjectivity. You could put it as a current asset as well. It's not clear. We'll just leave it as a non-current asset, but you could equally put that in current assets. Investments, be careful, they are now 30, and that's coming from working 7. So if you come back here, we increase the value of the investments by 2. So it's going from 28 up to 30. So if you want a reference there in the question, that investment is coming from working 7. So your total non-current assets are 234. And we've dealt within machinery, we've ticked it off, and we've dealt with motor vehicles. And that's all ticked off. So the more you have ticked off, the obvious ones are then left to make it easier to finish off the statement of financial position. You then go to current assets. You have inventory, which is coming from working 1. You're going to have bank, and you're going to have trade receivables. Inventory is 155,000. We have that from our initial journal entry up here. Debit current assets, 155. We go back to the statement. We have trade receivables, 300. So just be careful, trade receivables, 300. And we have a provision now of 15. So you net the provision off always when you're doing statement of financial position. So that's going to be 300,000 minus 15,000. It's always net of the provision, and that's coming from working 5. The bank is given directly in the question. It's a debit balance. That means it's an asset. If that bank was a credit balance, that would mean it is an overdraft and it would be a current liability. So we've dealt with receivables as well, and we tick it off, and we've dealt with investments. So slowly but surely making progress as you go through. No other assets there that are current assets. Just go back to your statement or your adjustments. There's no other one other than prepayments. So you have insurance prepaid, which is now going to be a current asset, prepayment. And that is working 4, 3,000. So that means your total current assets, 450, and you add that to your non-current assets to get your total assets, the first half of the balance sheet, now known as the statement of financial position, 684,000. And that's what you're going to try and make the equity and liabilities balance to as well. This is a tricky one. There is a good bit of work involved there. So it's important to take your time and lay it out correctly. And since check all your adjustments as you go through. So we didn't start off with equity and liabilities. So in terms of equity, we have share capital, ordinary share capital, and we have retained earnings. The ordinary share capital is easy. It doesn't really change. That is the 250,000. It's not the 300. It's the 250. Retained earnings, just be careful here. Retained earnings are not, the provision is already done, are not the 132. That's the opening balance. So it's going to be the 132 plus the profit for the year, which is 84. Right? You don't take away any dividends because we don't have them. So it's just profit for the year. So that means the retained earnings are going to be 216,000. And when you add those together, you get equity because we've no share premium, no revaluation surplus. You have 466. That is your total equity. To that, then we add our non-current liabilities, which we have 1. And that is our debenture. Our debenture we know is 70. So we can tick that off. That's one of the main credits. And the last one then is we have our payables. We've done retained earnings already. So you're left with your payables as a current liability. Trade payables. Excuse me. So trade payables, which are 69,000. I'll bring that back to this one here. Now, we've all our trial balance done. We've all of those highlighted, so we have them in the correct places. But we have to figure out then if we have anything else left out. We've left out the accrual for audit. So it's the audit accrual. That's 12,000 we're going to slot in. And we've left out the tax accrual for 60. And we've left out the interest accrual for 7. So see the way you can easily leave out a couple of things if you don't have that approach of ticking off as you put them in. So let's come down here. We have the audit fee accrual. We have the tax accrual, and we have the finance cost or the interest accrual. So slot those in. The audit fee accrual 12,000, tax accrual 60,000, interest accrual 7,000. And that is all our items, the adjustments for 8 workings, and all the items in the trial balance slotted in. So if we've done this correctly, this should hopefully balance up. You add up your current liabilities, 148, and then we say total equity and liabilities, they're going to sum to 148 plus 70 plus our total equity for the year, 466. And thankfully, that total equity and liabilities, 684, tots with the total assets that we have up there, 684 as well. And that's how you approach a simple IAS 1 question. You know your journal entries, you know your debits and credits, and then you have some technique of how you go through methodically the trial balance and your adjustments to make sure you slot everything in. Because if you go through that too quick, you'll leave out items and you'll end up having to go back over it, re-tot everything up, and it takes a lot longer. So come up with it and practice these IAS 1 questions. We're doing basic ones for now, just to refresh your memory. When we come back and start doing semester 2 material, we're going to layer on a lot new standards and new adjustments, which is going to make it a much more complex question. All right. So this particular recording looked at Keith Limited from the IAS 1 question pack.